Imagine waking up one morning and the price at your local gas station has doubled overnight. Not because of a new tax, not because of a hurricane, but because a single waterway has gone permanently dark. No tankers moving, no oil flowing, no end in sight. How would that change the price of literally everything you buy? What happens to the global economy when the world's most critical energy corridor simply stops working? Which comes first, financial collapse, geopolitical war, or the quiet starvation of entire industries? This is Money Deja Vu. Here's what would happen if the Strait of Hormuz never reopens. Before we start knocking over dominoes, let's talk about what the Strait of Hormuz actually does. Most people have heard the name without ever fully grasping the weight of it. Picture a narrow corridor of water between Iran on one side and Oman and the UAE on the other. At its narrowest point, this strait is only about 21 miles wide. That's it, 21 miles of ocean. Yet, this is the single most strategically important choke point on Earth. Every day, between 17 and 21 million barrels of oil pass through that strait. That's roughly 20% of the entire world's oil supply moving through a corridor. Not just oil either. Liquefied natural gas, petrochemicals, refined petroleum products, cargo vessels. All of it flows through that narrow blue throat between two hostile coastlines. The countries that pump their economies through this strait read like a who's who of global energy production. Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, Qatar, Iran itself, Bahrain. The combined GDP influence of that region, amplified by importing nations like Japan, South Korea, India, China, Germany, and the United States, creates an economic web so intricately interconnected that a single sustained disruption doesn't just raise gas prices. It rewires the entire architecture of global trade. The Strait of Hormuz is, in the most literal financial sense, the beating heart of the modern industrial economy. Every time a tanker passes through without incident, the world exhales a breath it didn't know it was holding. The global economy has been built around the assumption that this passage remains open. Insurance models assume it. Airline fuel contracts assume it. Grocery store supply chains assume it. Pharmaceutical cold chains assume it. The plastic in your phone case, the rubber in your tires, the synthetic fibers in your jacket, the fertilizer that grew your food, all of it, at some point in its supply chain, has a relationship with the oil that moves through those 21 miles of water. So what happens when that assumption breaks? Permanently, completely, irreversibly? Let's find out, week by week, month by month, year by year, and then decade by decade. Because this isn't just a story about gas prices. This is a story about the end of the world as we have financially organized it, and it starts faster than you'd think. The first sign most ordinary people notice isn't a news alert or a government announcement. It's the number on the gas station sign as they're driving to work on a Tuesday morning. And it's wrong, not slightly wrong. Aggressively, offensively, jaw-droppingly wrong. Within the first 48 hours of a confirmed sustained closure of the Strait of Hormuz, oil futures markets go haywire. In a way that makes the 2008 financial crisis look like a minor correction. Traders who have been stress testing this scenario for years suddenly find themselves living it. And the first thing they do is buy. They buy oil futures contracts with both hands, driving the price up so fast that circuit breakers on major commodity exchanges trigger automatically, pausing trading to prevent total free fall, or in this case, total free climb. Crude oil prices, which in a stable world might sit between $70 and $90 per barrel, spike past $150 within days. Some analysts will later say that conservative figure assumes rational market behavior, and rational market behavior is one of the first casualties of a genuine supply shock. The real number in classified government briefings in Washington, Brussels, and Tokyo is uglier than that. We're talking about $200 oil, maybe higher. Not as a peak that corrects back down, as a new, terrifying baseline, because the market is no longer pricing in a temporary disruption. It's pricing in permanent scarcity. At the gas pump, this translates with brutal swiftness. Americans who paid $3 a gallon last month are now staring at $6, $7, $8. In Europe, where fuel taxes are already baked in, you're looking at numbers that make people visibly flinch. In developing nations that import oil with currencies that have already weakened, the jump is catastrophic. Nigeria, Pakistan, Egypt, Indonesia, countries where a large portion of their income is spent on energy and transport, are already in crisis before the first week is out. But gas prices, as dramatic as they are only the most visible symptom. Underneath them, in the parts of the economy most people never see, something else is happening. Airlines are quietly doing math that doesn't add up. Jet fuel represents somewhere between 20 and 30% of an airline's operating costs in normal times. When jet fuel prices double or triple inside a single week, the entire profitability model of commercial aviation collapses. Airlines start calling extraordinary board meetings. They start canceling routes, first the low-margin ones, then the medium ones, then whatever they can to staunch the bleeding. Business travelers start getting emails that their regular flights have been suspended. Vacation bookings begin canceling. The aviation industry, which employs tens of millions of people globally and enables trillions of dollars of commerce, begins its quiet implosion in week 1. Shipping companies are having similar conversations. The cost of moving a container of goods from one side of the world to the other has just multiplied. Previously locked-in contracts are now instantly money-losing. Shipping firms start reviewing force majeure clauses. Legal teams are activated. Supply chain managers at major corporations start pulling their hair out. The cascading reality of what a permanent Hormuz closure means begins to sink in. In week 1, the grocery store still looks mostly normal. Shelves are stocked, prices are up a bit. But in warehouses, logistics networks, and quiet conversations, the alarms are already ringing. Everything in a grocery store has a supply chain. Almost every supply chain has a fuel cost built into it. From trucks delivering produce to fertilizers, pesticides, and plastic packaging, petroleum is embedded. In week 1, the people who understand that have stopped sleeping properly. In financial markets, equities are crashing. Energy stocks surge briefly, then fall. Investors realize even oil majors can't fix a permanently closed strait. Defense stocks jump, everything else falls. The S&P 500 posts its worst week since 2020. Pension funds bleed. Retirement accounts shrink. Consumer confidence falls off a cliff. When consumer confidence collapses, the real economy follows. Commerce begins to seize up. Week 1 ends with a world that looks mostly like the one we recognize but smells like fear. By the time a month has passed, temporary has been dropped from most official communications. Governments are still using careful language. Diplomats are still talking. Military posturing in the Persian Gulf is intensifying, making insurance underwriters reach for antacids. But the market has made its judgment. This is not resolving quickly. And that judgment changes everything about how businesses behave. The most visible change, the one ordinary people feel most viscerally, is at the grocery store. In month 1, the food supply chain begins to show its seams. Prices on fresh produce jump first. Strawberries that were $1.50 for a pint are now $3, then $4. Then the store is simply out. The trucking company has increased its fuel surcharge, making shipping perishables unworkable. Supermarket managers start getting on the phone with regional suppliers, trying to source locally. Meat prices do something alarming. The modern industrial meat supply chain is fuel-intensive. Feed grain for cattle and pigs gets grown with fertilizer, harvested with diesel machinery, transported in diesel trucks to processing facilities, then to distribution centers and stores. Every leg of that journey just got dramatically more expensive. Costs move through the chain. Month 1 is when the grocery store starts to look genuinely strange to ordinary shoppers. Modern industrial agriculture is deeply dependent on synthetic nitrogen fertilizer. Synthetic nitrogen fertilizer is made predominantly from natural gas through the Haber-Bosch process. Roughly half the nitrogen atoms in your body pass through a Haber-Bosch reactor. Qatar is one of the world's largest LNG exporters, and Qatar's gas flows through the Strait of Hormuz. The US, Australia, and Russia are also massive natural gas suppliers, unaffected by a Hormuz closure. Fertilizer supply doesn't collapse overnight. What happens instead is more insidious. Qatar's volumes disappear, prices spike hard. Price-sensitive buyers, developing nations, get priced out. Global fertilizer supply tightens. Agricultural pain is severe but uneven, hitting the world's poorest. Agricultural economists are writing urgent memos to senior government officials. Even a partial disruption to global fertilizer supply has consequences for hundreds of millions. The manufacturing sector begins shutting down in month 1, appearing as individual company decisions. But these are actually systemic. Plastics manufacturers face input cost explosions. This affects every downstream industry that uses plastic components, which is virtually every industry. Factories start going to reduced hours, then 4-day weeks, then temporary closures. Unemployment starts to tick up, first slowly, then with accelerating momentum as knock-on effects compound. The global shipping industry, already reorienting in week 1, is in full emergency mode by month 1. Container ships reroute around Africa via the Cape of Good Hope. This adds weeks to transit times and massively increases fuel costs. Insurance premiums for vessels near the Persian Gulf have become, in practical terms, prohibitive. Lloyd's of London, pricing global risk for centuries, posts war risk exclusion clauses. These effectively price Middle Eastern maritime commerce out of the market. Central banks watch this with expressions economists use to conceal pure, undiluted terror. The Federal Reserve, European Central Bank, Bank of Japan, and People's Bank of China face the same impossible dilemma. The inflation they watch is supply-driven, cost-push inflation. It's not fixable by raising interest rates. Raising rates when inflation is caused by supply destruction doesn't reduce prices. It causes recession on top of inflation. It gives you stagflation, like having both a broken leg and pneumonia simultaneously. Central bankers raise rates anyway, needing to be seen doing something. The stock market interprets this as no good option, falling further. Month 1 ends with grocery bills 30% higher, unemployment rising, and equity markets in a sustained bear phase. Policy elites recognize this is not a crisis resolvable with current tools. If week 1 was shock and month 1 was disruption, year 1 is transformation, not the inspirational kind. This is the kind of transformation historians later name very solemnly. By the 6-month mark, inflationary pressure from months 1 through 4 has broken containment. The consumer price index in most developed economies is running at levels not seen since the 1970s. In some countries, it's running at levels not seen in living memory. The United States experiences double-digit inflation. Germany, with its deep cultural memory of Weimar-era hyperinflation, experiences something making older Germans very quiet. Japan, fighting deflation for 3 decades, watches prices rise with surreal disorientation. In the developing world, nations spending heavily on energy imports face genuinely catastrophic situations. Let's talk about the petrodollar, because year 1 is when this structure, underpinning global finance since 1974, shows its first real stress fractures. It's important to be precise here, as the dramatic and accurate versions diverge significantly. The petrodollar system is the arrangement where global oil trade is priced and settled in US dollars. It was formalized through agreements between the United States and Saudi Arabia in the 1970s after Bretton Woods collapsed. Saudi Arabia and Gulf states agreed to sell oil in US dollars and recycle profits into US Treasury bonds. In exchange, the United States provided military and diplomatic backing to the Gulf monarchies. This arrangement reinforced the dollar's status as the world's reserve currency and gave the US unique borrowing ability. Now, a permanent Hormuz closure puts genuine pressure on this system. Gulf states' dollar revenues fall sharply. Their capacity to recycle petrodollars into US treasuries weakens. Global trade settled in dollars, contracts as oil trade contracts. China, building yuan-denominated oil trading infrastructure for over a decade, uses the disruption to accelerate ambitions. Nations already trading outside the dollar system, Russia, Iran, and increasingly India, expand bilateral currency arrangements. All of this is real, documented, and directionally significant. But here's what the dramatic version of this story gets wrong. The dollar doesn't wobble seriously in year 1. The petrodollar system is institutionally entrenched in ways that 1 year of disruption, however severe, doesn't dislodge. The dollar is held in reserve by nearly every central bank, not just because of oil, but due to US capital markets. Also, the rule of law backing US debt and the sheer inertia of a 50-year global standard. What year 1 produces is not a dollar crisis. It produces a dollar trajectory change. The long-term direction of dollar dominance shifts from gradual and stable to gradual and declining. That distinction matters enormously because a slow trajectory change gives institutions time to adapt, whereas an acute collapse does not. The slow version is still very consequential. It just plays out over years and decades, not months. What does hit hard in year one is the inflation picture. The Federal Reserve and its counterparts face the same impossible dilemma. The inflation they're watching is supply-driven, cost-push inflation, which means it's not fixable by raising interest rates. Raising rates when inflation is caused by supply destruction doesn't reduce prices. It just causes a recession on top of the inflation. You get stagflation, which is the economic equivalent of having both a broken leg and pneumonia simultaneously. The central bankers raise rates anyway because they have to be seen doing something, and the stock market falls further. Food systems are in open crisis by the end of year one. The fertilizer shortage, a warning in month one, is structural reality. Global grain production is declining, not catastrophically yet, but measurably. Agricultural ministries watch with dread. The World Food Programme flags food security emergencies in 40 countries. The IMF coordinates emergency lending to 30 more. The quiet assumption that the global food system would produce enough calories is beginning to look less solid. And then there is the geopolitical dimension, which in year one begins to intersect with the economic dimension in deeply destabilizing ways. The Gulf Cooperation Council nations face internal political pressures. Oil revenues evaporated, sovereign wealth funds drawn down. Authoritarian structures struggle to cope. Saudi Arabia's Vision 2030, premised on oil revenue, is catastrophically undermined. The kingdom is spending reserves at a pace that analysts are computing terminal dates for. The UAE, more diversified, fares better but faces severe strain. Kuwait and Bahrain, smaller, are in genuine fiscal crisis. Iran, the primary actor in a strait closure, is not faring better economically. This point often gets lost. Iran is an oil-exporting nation. Its oil is as trapped behind a Hormuz closure as everyone else's. The Iranian economy, damaged by sanctions, would acutely contract under permanent closure. Unemployment would rise. Import costs for goods would increase as global supply chains seize up. The public would face additional pressure. The IRGC, controlling the closure, bets geopolitical gains outweigh domestic economic cost. That is not obviously a winning bet. Analysts debate if any Iranian government could sustain a permanent closure politically against internal economic pressure. What makes the scenario genuinely dangerous is not that Iran would be comfortable with the consequences. It's that a government under sufficient strategic pressure might judge the damage to its adversaries' economies as worth the damage to its own. Nations operating from desperation rather than strength are the ones that take gambles that rational calculation wouldn't recommend. The United States 7th Fleet and allied naval forces have been conducting operations in and around the Persian Gulf since week one. By year one, this has evolved into one of the largest and most expensive sustained naval deployments since the Second World War. Aircraft carrier groups, destroyer squadrons, submarine assets, maritime patrol aircraft, all operating continuously at enormous cost. The defense budget implications are staggering. The human cost, in terms of sustained high-tempo operations, is quietly becoming a readiness crisis. Year one ends with the world's financial architecture more damaged than it has been since World War II. Food prices 60 to 80% above pre-crisis levels. Energy prices that have fundamentally restructured every industry on Earth. A petrodollar system visibly losing trajectory rather than collapsing. And a geopolitical situation in the Middle East that makes every other regional crisis look manageable. And we are only 12 months in. Here is where the analysis gets genuinely strange, because a decade without the Strait of Hormuz doesn't just mean a sustained economic depression. It means a fundamental reorganization of which countries have power, which technologies dominate the energy landscape, which currencies anchor global trade, and what daily life actually looks like for ordinary people across different parts of the world. Some of what emerges is grimmer than anything we've discussed so far. Some of it, and this is important to hold on to, is the kind of transformation that was necessary. And that crisis has simply accelerated beyond what peaceful consensus could have achieved. Let's start with the grim parts, because intellectual honesty requires it. Saudi Arabia, the linchpin of the Gulf economy, faces a genuine fiscal reckoning within the first several years. The pace at which the kingdom would need to draw down its sovereign wealth fund, the public investment fund, depends heavily on how aggressively it cuts domestic subsidies. A complete depletion in 3 or 4 years is not realistic unless spending remains completely unreformed. The more accurate picture is a kingdom under sustained and worsening fiscal pressure, making increasingly painful spending cuts. Facing a population accustomed to heavily subsidized energy, food, and housing, while its economic diversification program, Vision 2030, loses the oil revenue funding it was premised upon. The social and political strain of that trajectory, not an overnight fund collapse, is what creates instability. The timeline for political transition is genuinely uncertain, but the direction of travel toward a structurally weaker Saudi state with diminished regional influence is hard to argue against. In a world where its primary export revenue has been cut off, Iraq, already one of the more fragile states in the region before the crisis, fragments under the combined pressure of economic collapse, sectarian tension, and power vacuum. The Kurdish north moves toward formal independence. The Shia south aligns more deeply with Iran. The Sunni center becomes a contested space. Now let's talk about who gains, because every massive geopolitical disruption has winners. The United States, which suffers enormously in the short and medium term, has structural advantages that matter enormously in a decade-long horizon. It has the world's largest proven shale oil and gas reserves. It has massive domestic energy production capacity. While insufficient to replace the lost Gulf volumes immediately, provides a foundation that no major European nation can match. The shale revolution of the 2010s made America energy independent for the first time in decades. Meaning the US, while experiencing severe economic pain, is not existentially threatened in the way that Japan or Germany or South Korea is. By mid-decade, emergency domestic production increases, combined with the rapid build-out of renewable energy infrastructure. Driven by the price signal of $200 oil, have made the United States significantly more energy self-sufficient than it was before the crisis began. But Europe has something important. Political unity, however imperfect, and the institutional capacity to coordinate a response. The European Green Deal, already the world's most ambitious clean energy policy framework, is upgraded to a wartime-level mobilization. The EU issues emergency joint bonds to finance the largest infrastructure investment in European history. An accelerated build-out of offshore wind, nuclear, hydrogen, and grid infrastructure at a scale that 27 nations can achieve. It is painful, expensive, politically contentious, and takes most of the decade to show results. But the results, when they come, are structurally transformative. By year 8 or 9, Europe's energy import dependency has fallen to levels impossible to achieve without this crisis. China is the most complicated case study. It's the world's largest oil importer, 40% from the Persian Gulf. A permanent closure is an existential economic threat, and Beijing treats it as such from day one. The Belt and Road Initiative, building infrastructure across Eurasia for a decade, suddenly reveals its strategic depth. Overland pipelines from Russia, Central Asia, Myanmar, and maritime routes through the Indian Ocean provide diversification. China also accelerates its domestic renewable build-out with a ferocity that makes pre-crisis investment look modest. China was already installing more solar capacity than the rest of the world combined before the crisis. With oil at $200 a barrel, investment intensifies, reshaping the global solar manufacturing supply chain. China also uses the crisis to accelerate its petroleum ambitions. Gulf states, desperate for trading partners, buy their oil in yuan on Chinese financial infrastructure. The geopolitical leverage this provides is enormous. Nations reluctant to denominate energy trade in yuan find their reluctance dissolving. The alternative is continued exposure to a dollar system that is itself under stress. By mid-decade, the global reserve currency landscape looks genuinely different. The dollar remains dominant, but its dominance is structural rather than unchallenged. The yuan has established a meaningful secondary reserve currency role. A basket of currencies, formalized through a reformed IMF special drawing rights arrangement, handles a growing share of global commodity trade. Gold, perennially dismissed by mainstream financial economists, experiences a sustained price appreciation. This vindicates the central banks of Russia, China, India, and Turkey, who have been accumulating it quietly for years. The petrodollar system doesn't die in a day. It ossifies. Its influence gradually diminishes. The US still benefits from dollar reserve status, but the automatic demand for dollars is functionally gone. Now let's talk about the energy transition, Because this is where the decade gets genuinely interesting in ways that aren't entirely dark. $200 oil for a sustained period is, paradoxically, the most powerful renewable energy subsidy in human history. Not because someone decided it, not because a political coalition agreed to it, but because markets work. When fossil fuel energy rises by 150 to 200%, the economics of every alternative energy source change fundamentally. Solar power, already at cost parity with new coal plants, is now dramatically cheaper than any fossil fuel alternative. The payback period for a residential solar installation drops to 3 to 4 years at post-Hormuz energy prices. Installation demand explodes. Wind power, geothermal, tidal, all experience similar economics-driven demand surges. The constraint is not demand. The constraint is manufacturing capacity. Making solar panels requires equipment. Making wind turbines requires steel and rare earth materials. Building out electrical grid infrastructure requires copper, aluminum, and engineering capacity. In the first few years, these supply constraints mean the physical build-out happens at a pace that still leaves enormous gaps. These gaps are years, not decades, long. But in those years, ordinary people's lives are genuinely hard. Electricity rationing, which developed world populations had not experienced since World War II, returns to parts of Europe and Asia. Industrial users are the first to have their power curtailed, meaning more manufacturing shutdowns, unemployment, and economic contraction. Residential users face higher bills, time of use pricing, and actual rolling blackouts during peak demand periods. The social contract between governments and citizens, which included reliable, affordable energy, is visibly under strain. And yet, underneath this strain, something is building. By year 5, the curve bends. The new energy installations ordered in the crisis years are coming online. Grid storage capacity, driven by the same economics that drove EV batteries, is making intermittency problems more manageable. Hydrogen electrolysis, powered by cheap renewable electricity, is beginning to provide a credible fuel for heavy industry and long-haul transport. The economic pain of the transition is not over, but its character is shifting from acute crisis to chronic adaptation. And the direction is, for the first time in the decade, clearly positive. Let's talk about what this decade means for ordinary people's daily lives, because the macroeconomic story is only meaningful insofar as it connects to the texture of actual human experience. Food is permanently more expensive than before the crisis, but not unaffordably so in developed nations by mid-decade. This is because the fertilizer supply chain has been reorganized. New natural gas supplies from North America and Africa have been developed through alternative routes. Green ammonia production, making fertilizer from renewable electricity, has been scaled with emergency priority. Local and regional food systems have been rebuilt with government support, reducing food miles for urban populations. The grocery store looks different. More local and seasonal produce, less out-of-season variety. Higher prices overall, but it is stocked. Personal transportation is transformed. The decade sees the fastest mass adoption of electric vehicles in history, not because of environmental idealism, but due to pure economic calculation. At post-Hormuz fuel prices, EV ownership costs are dramatically better than internal combustion alternatives. Used EV markets become robust and affordable. Public transit, long underfunded in American cities, receives emergency federal investment. It's not possible to run a major metropolitan economy if workers cannot afford to commute. Air travel contracts severely and permanently. The volume of air travel is a fraction of what it was. Business travel is almost entirely replaced by video communication for routine purposes. Leisure air travel becomes genuinely expensive, a luxury item rather than a middle-class norm. The airlines that survive are leaner, operating on higher margin routes, often with newer, more fuel-efficient aircraft. Global supply chains are shorter by the end of the decade. Not because governments mandated it, but because the economics of transoceanic manufacturing arbitrage changed. American and European factories producing things previously made in Asia reopen. This creates jobs in developed economies and eliminates jobs in developing ones, producing complex secondary effects on global inequality that don't resolve cleanly into simple narratives. The nations that suffer most are those most dependent on oil export revenues and least diversified. and simultaneously those most dependent on oil imports, doing the least to develop alternative energy sources. The Middle Eastern petrostates and certain import-dependent developing economies bear the worst of it. Nations that invested in energy transition infrastructure and renewable capacity before the crisis find acceleration. The decade, while painful, accelerates them into a new energy paradigm. The oil era doesn't end cleanly. It never does. Oil remains a significant input into petrochemicals, plastics, synthetic materials, and specialized fuels. The Gulf region retains geological and geographic significance that doesn't disappear overnight. But the era where a single narrow waterway constitutes the linchpin of the entire global economy, that era ends. Not because of a political decision, or a climate agreement, or a technological moonshot. It ends because the markets, faced with undeniable evidence of the catastrophic fragility of the system, price in a different future. The petrodollar's dominance is reduced but not eliminated. The dollar remains important. America remains powerful. But the unipolar financial world gives way to a more multipolar arrangement. This is disorienting for Americans who grew up in the unipolar world. It is less disorienting for the majority of the planet who never benefited from that arrangement anyway. The nations that invest in new energy infrastructure and domestic renewable capacity emerge with structural economic advantages. The nations that don't, whether from poverty, institutional dysfunction, or political paralysis, fall further behind. In ways that produce humanitarian consequences that are not speculative. They are genuinely terrible. And the Strait of Hormuz itself, still there. Still 21 miles wide. Still sitting between Iran and Oman and the UAE. But in the world that has reorganized itself around its closure, the waterway has lost its grip on the global economy's windpipe. It is no longer the beating heart of industrial civilization. It is a scar, a reminder of how fragile the systems we build can be. A reminder that a choke point only holds power over you as long as you allow your most critical systems to depend on it. The world didn't plan to change. It was forced to. And like every forced transformation in human history, it left behind enormous wreckage, enormous suffering, and buried beneath all of it, the seeds of something genuinely new. The question, as always, is not whether we could have seen this coming. We could have. The analysts writing about Hormuz vulnerability have been publishing their work for decades. The question is what we do with that knowledge before the scenario becomes the reality. Because the version of this story where we transition our energy systems, diversify our supply chains, and reduce our choke point dependencies before a crisis forces us to, that version is available. It is within the scope of human institutional capacity to execute. It is simply a matter of whether the urgency becomes real before the crisis or only because of it. That's the real lesson the Strait of Hormuz has been trying to teach us, quietly, for 50 years. Not that oil is valuable. We knew that. But that the assumption of perpetual access to a resource that flows through a vulnerable geography and the building of civilization-scale systems on top of that assumption is a bet that, at some point, history will call. Whether we're prepared for that call is right now an open question. And the answer to it will define the next century of human economic history more completely than almost any other variable currently in motion. That's what happens if the Strait of Hormuz never reopens.